Welcome to StockTok's deep dive into Alphabet Incorporated. Alphabet is the parent company of Google, the world's dominant search engine, as well as YouTube, Google Cloud, and a portfolio of moonshot ventures. At the time of recording, the stock is trading at 339.4, within striking distance of its 52-week high of 350.15, and well above its 52-week low of 148.4. The 50-day moving average sits at 306.98, above the 200-day moving average of 272.55, a technically constructive alignment. The RSI, or Relative Strength Index, reads 73, which is technically overbought territory and warrants some caution around entry timing. Let's work through the fundamentals, scene by scene. Starting with a quick business overview. Alphabet generates the vast majority of its revenue through advertising on Google Search and YouTube, with Google Cloud emerging as a fast-growing second engine and artificial intelligence woven through every segment. The moat is formidable: distribution scale, proprietary data, and deeply embedded user habits that would take years to displace. The StockTok score stands at 66 out of 100, a buy signal. The company scores near perfectly on financial health and profitability, earns strong marks on growth, but scores low on valuation, a reflection of the premium the market is currently attaching to this franchise. Smart money positioning is mixed, as we will see. Now, valuation. The question every investor has to answer: are you paying the right price? At the time of recording, Alphabet trades at a trailing price-to-earnings ratio of 31.61 times, meaning investors are paying roughly $32 for every dollar of trailing earnings. The forward price-to-earnings ratio, based on projected future earnings, compresses slightly to 29.52 times, which suggests the market expects earnings to grow into the current price. The PEG ratio, which adjusts the price-to-earnings multiple for growth and ideally sits below 1 for a value signal, reads 1.64, indicating the stock carries a meaningful growth premium. The enterprise value to EBITDA multiple, a cleaner cross-company comparison that accounts for debt and cash, comes in at 22.43 times. For context, large-cap technology and communication services peers have historically traded in a similar range, so this is not an outlier, but it is not cheap. The GF value, an independent intrinsic value estimate, sits at 216.91 at the time of recording, implying the stock is trading at a 57.52% premium to that estimate. That is a notable caution flag. Wall Street analysts at the time of recording have a consensus mean price target of 360, based on 17 analysts, with the high end reaching 405. In our view, this suggests the street sees measured upside from current levels, but acknowledges the range of outcomes is wide. Market sentiment around Alphabet, as of the creation of this video, leans cautiously bullish. Analysts are focused on artificial intelligence leadership and cloud momentum, even as valuation remains elevated. In our view, the valuation setup is stretched relative to intrinsic value models, though the quality of the franchise partially justifies that premium. Moving to financial strength, how solid is the foundation? The Piotrowski F-score is a 9-point checklist that scores a company across profitability, leverage, and operating efficiency signals. Alphabet scores 8 out of 9, an exceptionally high reading that places it firmly in the financially robust category. The Altman Z-score, a model designed to estimate the probability of financial distress, comes in at 16.27. Any score above 3 is considered safe. 16.27 is essentially a fortress balance sheet reading. On debt, the cash-to-debt ratio stands at 2.14, meaning the company holds more than twice as much cash as it owes in total debt, a position most credit analysts would consider pristine. Interest coverage, which measures how many times operating earnings can service interest expense, is 175.32 times. That is not a misprint. Alphabet's debt burden relative to its earnings power is almost negligible. The current ratio, current assets divided by current liabilities, reads 2.01, confirming strong short-term liquidity. Debt to equity is 0.14, a leverage level so low it barely registers. In our view, the balance sheet here is one of the cleanest in global equity markets, full stop. Next up, profitability. Is this business actually making money efficiently? We lead with return on invested capital, or return on invested capital, the single metric that, in our view, most reliably separates great businesses from merely adequate ones. It measures how effectively management deploys every dollar of capital back into the business. Alphabet's return on invested capital stands at 29.69%. A reading above 15% is generally considered excellent. Nearly 30% puts Alphabet among the most capital-efficient large-cap businesses on the planet. Working down the margin stack, gross margin, the percentage of revenue retained after direct costs, is 59.65%, reflecting powerful pricing leverage in its core advertising business. Operating margin, which captures costs of running the entire enterprise, is 32.03%. Net margin, the bottom line profit retained after all obligations including taxes, is 32.81%. That level of net margin in a business of this scale is genuinely exceptional. Free cash flow margin, the cash actually generated after capital expenditure, is 18.19%, confirming that reported profits translate into real cash. The profitability score of 20 out of 20 on the StockTok scorecard is, in our view, entirely justified by these numbers. Onto growth. Is this business expanding, and at what rate? Over the trailing 3 years, Alphabet has compounded revenue at 12.5% per year. Extend that window to the trailing 5 years, and the annual revenue growth rate rises to 18.1%, a figure that, for a business generating revenue in the hundreds of billions, is genuinely impressive. Most mature businesses of this scale struggle to grow at mid-single digits. Alphabet has been compounding at well above that rate for half a decade. Book value per share, the accounting measure of net assets attributable to shareholders, has grown at 19.9% annually over the trailing 3 years, which confirms that management is not just growing the top line, but is building durable, balance sheet wealth at pace. The dividend yield stands at 0.25%, effectively nominal. Alphabet only recently initiated a dividend, and at this stage, the yield is symbolic rather than income generating. We would not own this name for the dividend. The growth narrative, in our view, is anchored in 2 vectors: the continued monetization of artificial intelligence within search and YouTube, and the scaling of Google Cloud, which is structurally underpenetrated relative to peers. The risk, which the data suggests the market is beginning to price in, is whether revenue growth decelerates meaningfully as the base grows larger and competition in AI intensifies. Now let's talk smart money. What institutional capital is actually doing with this name? 56 top-tier guru investors currently hold Alphabet in their portfolios, a broad and deep roster of long-term capital allocators. Among the most concentrated holders, Lai Lu of Himalaya Capital Management has the stock at 21.55% of his portfolio, with no recent change, a position that signals very high conviction from one of the most respected value-oriented investors in the world. Brian Lawrence of Oak Cliff Capital holds it at 15.9% of his portfolio, also with no change, reinforcing that concentrated, patient capital thesis. Thomas Russo of Gardner Russo & Quinn carries a 13.32% position, but has reduced it by 15.46%, which is worth noting. A trim from a long-term holder suggests some reallocation at current prices. Bill Ackman of Pershing Square Capital Management holds 12.46% of his portfolio in Alphabet, but has made a small reduction of 2.53%. Triple Frond Partners has reduced its position by 35.84%, the most aggressive trim among the top holders, and a data point we would not dismiss. Turning to the broader institutional picture, only 27.5% of 13F filers, the large institutional money managers required to disclose holdings, are net buyers, well below the 50% threshold that would constitute a broadly bullish institutional posture. Insider ownership sits at 3.16%, which is moderate. Critically, insider transactions over the most recent 3 months show 0 purchases and 16 sales. Insider selling at scale while the stock approaches its 52-week high, combined with below-median institutional buying activity, is a setup that warrants attention, in our view. And finally, the verdict. Let's bring it all together. On valuation, the data suggests Alphabet is trading at a meaningful premium to intrinsic value models, and while the street sees modest upside to consensus targets, the margin of safety here is thin, in our opinion. On financial strength, the balance sheet is, in our view, among the best in global equity markets, near-perfect Piotrowski score, a negligible debt burden, and interest coverage that is essentially irrelevant as a risk factor. On profitability, the return on invested capital and margin structure place Alphabet in genuinely elite company. This is a business that converts competitive advantage into cash at an exceptional rate. On growth, the trailing revenue compounding is impressive for an organization of this scale, and the artificial intelligence and cloud vectors offer credible long runway expansion, though deceleration risk is real as the base matures. On smart money, the positioning is mixed. Concentrated long-term holders remain, but notable trims from respected managers, below-median institutional buying, and a pattern of insider selling at elevated prices are signals we would want to monitor carefully. Overall, based on what we see, Alphabet represents a high-quality franchise trading at a premium price. The thesis rests on the durability of its competitive moat and its ability to monetize artificial intelligence at scale, and the bear case rests on valuation compression if growth slows. Everything in this video is our interpretation of publicly available data, not financial advice. Please consult a licensed financial advisor before making any investment decisions. That's the deep dive on Alphabet Incorporated. Like and subscribe so we can keep providing you with no-nonsense, data-driven analysis of stocks. We will keep updating our videos as soon as new data that affects the stock becomes available.